Hey, it's Soleil, and I'm enjoying making the series, but my goal of doing a video almost every day in 2024 is it's brutal. And I was sitting there watching the recording of the actually I was almost caught up to the live, but it was Dallas and Green Bay, and then I'm like, oh shit, I gotta do my video today, so. Um, let's just go for it. So I thought maybe I would talk about how I got wrecked. Uh, I basically blew up my account doing poor man's covered calls, and then also I think I used this chart before I actually started this series, um, but it just kind of shows how long it would take to get to 10,000 shares of stock if you're buying one additional share a week from the premium that you collect on the covered calls. But let's just start here. So um, this is right after the crash, and I had was it a 401k? Yeah. And so I took my money out of my 401k, I paid the tax penalty, and just decided I'm going to trade for myself. And I was selling a bunch of covered calls, um, actual covered calls, so owning the shares, no real upside risk, because you can just um, hand over you know hand over the shares instead of having to go out to the market and buy them. And, and as you can see, the whole market is pumping, and so I was doing better than the market, but I still had this paranoid feeling like, what do I not know? Everybody's making money, and I'm making more money than the S&P. However, right around here, a couple of things happened. So I was trading a lot of Tesla. I can't remember if I had mining stocks back then. Probably did. So a couple of things happened. This was the end of the bull market, the 4-year cycle for Bitcoin, and really shitty timing, or could be maybe prophetic timing if you think Bitcoin was designed to follow the current economic cycles to begin with. Then maybe this is on purpose. But the Fed started raising rates, and everything shit the bed. And as you can see here, by the time I got here, I was so used to making money in these covered calls, and sure, losing some money temporarily when some stocks would crash, um, but always just bouncing right back, and it's just not being a problem. And so I got so comfortable with this that I started trying to um, sell leaps, which are long expiration anticipatory securities. So you buy deep in the money calls way out in the future, and it kind of acts like a synthetic stock, but it's a lot cheaper than buying 100 shares. So I was able, basically for the price of 100 shares, which would entitle you to sell one covered call, I was buying 2 leaps, which would entitle me to sell 2 covered calls. And that was working great as long as everything is going up, because the value of your leaps is going to go up at the same rate as the dollar amount of the stock, but you're only paying half. So it's kind of like, you're paying half price for the stock, and I was getting the same returns on the covered call. So this was working out great. But let's just show you why this doesn't work forever. Oh, and of course I lost it. All right. So to set this up, you got to go out at least probably 6 months, but probably a year is better. So let's go 369 days. So the price of Riot right now, if you want to, and really, I mean, Riot is so cheap that there's kind of no point in even doing this, except that it's so cheap. If you did lose all your money on this strategy on one of these, it probably wouldn't matter. But actually, maybe it's better to do this on a Tesla, because this will show you really how I got crushed. So let's go out 369 days. Let's go deep in the money. Let's do something that's like at least a 0.8 delta. Okay, this works. So this means that the price of the stock, when it moves $1, will move the price of this option 85 cents. So pretty good. And instead of paying $22,000 for 100 shares, you can pay, geez, almost a third of that, but definitely less than half. And whereas it would cost you 22 grand to sell a covered call in Tesla, now you could buy 2 of these for 17 grand and sell 2 covered calls. So that was working great until the Fed pumped up the interest rates and all the tech stocks shit the bed. And just to give you an idea, if you bought a Tesla for $220 a share, and the price drops in half, that's below the strike. So now you don't have an in the money stock anymore. Now you have an out of the money stock. So what's $50 out of the money right now? $30 a share. So imagine the value of this stock, your value dropping by 5,700. That's dropping 2/3. So while the price of the stock dropped half, you lost 70%, or maybe even more. I'm just kind of guessing at this time because the delta is going to change as the price increases. So like way up here to 270, the delta is 45 cents. And then it gets so low that, like, if you had purchased the $300 leaps, and now the price is 220, you can't, you need to sell a covered call above this strike, and you can't. There's no way that you could find some premium for that. So I used to trade all kinds of stuff, so I don't know if it was technically diversified, but I would trade anything that had high implied volatility or could get me a lot of premium. Now I just trade Tesla and Bitcoin because I think they're the winners, the clear winners in their industry, and there's no second best, really. So they're my assets for the next 5 or 10 years, and not financial advice disclaimer, but that's what I'm doing. So I'm back to doing what I should have been doing all along, because even if basically these leaps that I've purchased became completely almost worthless because the value dropped by more than 70%, and then they weren't even useful to sell covered calls and generate more. Whereas if you bought Tesla for 220, and actually that did happen to me. I bought 2 Tesla when it was 220, between 220 and 240, and the price did go down to 100. And I was selling covered calls the whole way down. and using that to buy more shares of Tesla. So then when Tesla did bounce back up to 220, I had more shares than when I started, so it just all worked itself out. That was owning the shares was what protected me from not blowing up my account this time, whereas owning these leaps so that I could construct a poor man's covered call, that put me at risk to completely blow up my account. So that's just a warning. Don't do what I did. Don't blow up your account. However, let's just say that you're not an idiot and you buy the shares so that you don't lose your ass. And you pick the, right here, the 225 next Friday. You get $236. Buy yourself another share of Tesla. So I filled out this spreadsheet. You purchased, you had 100 shares already, and you got 1% premium. And let's just assume that the price of Tesla doesn't even go up for the next year. So you get no additional value in from Tesla going up. I mean, and you're giving yourself, it could go up 2 to 3% a week here as well. But we're just ignore that and say that Tesla trades sideways for as long as we own it. We never get one single dollar of profit because of the share price is going up. So you purchase 1 share a week. It's going to take you 100 weeks to get your next 100 shares. Then you're going to start purchasing 2 shares a week, and it's going to take you 50 weeks to get another 100 shares. Then you'll have 300 shares, and you start selling 3 covered calls and purchasing 3 shares a week. It's going to take you 34, rounding, to get your next 100 shares. You'll be able to start buying, et cetera. You get it. Every time you get another 100 shares, you can sell an additional covered call, and if you're collecting 1% premium, you're going to be able to purchase an extra share. And every time you do that, the time it takes to get an additional share decreases. It goes from 100 to 50, 34 to 25 to 20, and after, if you add this up, and here's the total shares that you'll have at these milestones. And I said it previously that if you want to get to 10,000 shares, or I want to get to 10,000 shares, so that every week I'm purchasing an additional 100 shares. And so now, every single week, I purchase another 100 shares, and I sell an additional covered call. This is where I'm trying to get to. And it took 573 weeks to get the 10,000 shares, which is 11 years to get to critical mass. And then you're going to be able to buy 100 shares every week of whatever stock you're trading. So if you're trading, Tesla, you're going to be getting 1% on that. And, if you're doing Riot, you're getting 1%. Probably more than 1% on this. And that's why I like trading things with high volatility. So anything Bitcoin related is going to have high volatility. Used to be able to get way more premium on Tesla. I'm actually kind of brokenhearted that we're so close to earnings. As you approach earnings, implied volatility increases, and there's due to the anxiety about is the stock going to go up or down for earnings. So you can usually get the best premium in the weeks prior to an earnings call, but Tesla's premium has been disappointing. However, I continue to trade it because I'm just as interested in the value of Tesla. I think they're going to give Musk another compensation package or whatever, and he's going to have to, like, probably increase Tesla's market cap to some ginormous number. And he's always hit those goals before. So would not surprise me if in 10 years it's 10x or whatever, probably even before then. But anything can happen, but that's what I got my fingers crossed for. So, I mean, you can come all the way up to the 14.5 strike and still buy a share. You can see I was a little greedier, and I got like 22 cents because this is over the weekend now, so this was a different number. And actually, a quick note on theta, and this is the point of selling covered calls. So every day, the price of this call is going to drop by like 5 cents. Now, it doesn't actually, that's kind of an average, because I think most of this comes out probably from Thursday to Friday, the day before the expiration. But that's the point, is every day that goes by, the call that the person bought from you, you sold a covered call, but the call that they bought from you decreases in value every day. So that means if you want to buy it back on Friday, it's getting 5 cents cheaper every single day. But yeah, I got 22 cents, so I'm already, even though I don't have, or even if I think I only have 100 shares of Riot. But so even if I only have 100 shares of Riot, I'm already here buying 2 shares a week. So that's like jump starting from, the 100 weeks it's going to take to get another 100 shares to only 50. So anytime you can collect more premium, you're going to get to the next hurdle of 100 shares faster because you're going to be able to purchase more shares. However, it does put you at a little bit of a risk, like, why not go all the way down here at the money? And that's because if the price goes up more than 12 cents, these shares could get called away. And you're not leaving near enough call away value in this. Sometimes I try to keep them about even. Like, maybe I can get 5% call away value and 5% premium. I mean, that's pretty awesome. So let's see, 5% of the current share price would be 55 cents. So as long as you go up to 12 bucks, yeah, right here. So you could sell the 12 strike. That's giving you 62 cents of call away value and 58 cents, of premium. That's still a little, the price of these stocks can jump up so much that I think that's even a little bit too greedy. So that's why I went with the 14. And actually the price might have been 12-ish when I sold it anyway. The price of Riot, I think, maybe dropped since then. But yeah, and I just made another chart for fun. If you really can get 5%, then it's only going to take you 80 weeks. Is that right? Yeah, 20 weeks. Yeah, that's a sum. So 20 weeks to get your next 100, then 10 and 7, and then a whole bunch of 2, boom. So that's only, what, a year, almost 2 years? Yeah. All right, so I think that's about it for the day. Just a lesson learned, how I got wrecked, so that you don't get wrecked, and what your expectations should be with this strategy. So it's not too good to be true, get rich quick, scheme or whatever. It's just a strategy to sacrifice maximum profit. I'm sacrificing any profit over $14 by doing this. So if you're gonna be kicking yourself because the price went to 20 based on some kind of news or whatever, and you don't get the full pump, if that's going to keep you up at night, then this strategy is not for you. However, if you're fine with, selling this, buying a couple shares, and then limiting your upside on some of the shares, but then however many extra over 100 you have, you're getting the full upside on those. If that's cool with you, and if you're cool with taking 80 weeks or 573 weeks in order to reach this critical mass, actually, yeah, you know, go for it. And yeah, just allocate your funds properly. So maybe you only want to do this strategy with 1% of your money, or 5%, or 10%, or whatever your risk tolerance is. Now, I do this with 100% of my portfolio, and my portfolio is about half Bitcoin stocks and half Tesla. So, what was it? I don't know. Michael Saylor, the CEO of MicroStrategy, he talks about conviction. Like, if you have conviction about something, why would you diversify out of it? A lot of times he'll say it's selling the winners to buy losers. However, I will sell Tesla if it's up to get more Bitcoin stocks, or if Bitcoin's up and Tesla isn't. I kind of use them as a trading pair in that sense. But I have not tracked to say whether that's actually given me an advantage. I just enjoy it. It kind of makes sense to me, but I haven't really looked at the numbers and seen if I'm wasting my time doing that. I just it seems like it should work, and so in a common sense way. So I do that as well, and I think I'll leave it there. All right, be good, Joel.